Welcome to ETF Edge, your go-to place for everything exchange-traded funds. What's going to work for ETFs in the second half? Despite a strong first-half performance for the broad equity markets, ETF equity flows have been subpar this year. I would call it downright disappointing. The big money has gone into Treasury ETFs and money market funds. Even technology ETFs have seen outflows. What's the playbook for the second half? Let's talk with Todd Sohn. He's the ETF and technical strategist at Strategas. Dave Noddick, my old friend, Vetify, financial futurist. Todd, all the money in the first half has gone into treasuries and money market funds. I don't know if we can put up this full screen, but the technology sector is up 30%, but there's been outflows. This is amazing to me. Somebody is really behind the eight ball here. Outflows from energy and value equity ETFs. How do you explain this lack of enthusiasm for equities?
Just utter disbelief that we've entered a new bull market, a new cycle higher, right? You talk about back at the October lows, and even through the fourth quarter and first quarter of this year, investors were worried about inflation becoming unanchored. They were worried about a recession perhaps sometime this year, and everyone was happy with 5% yields. Any sort of conversation you had was about, oh, I can get 5%, I'm good to go now. That is until stocks had a
but they're not good to go. The real returns have not been that great in bonds. Dave, weigh in here. I mean, how long are investors going to cling to their 5% money market funds? When inflation adjusted, it's not doing that great. And also when we see the NASDAQ 100 up, what is it, 39% this year? The S&P is up 16%. The largest bond fund, I looked at AGG, Dave, it was up 2.5%. And that's all in. So somebody's got to be getting some FOMO this year. No, I keep waiting for this to happen.
Well, we've started to see some of that. I mean, we talk about equity flows being anemic. It's 127 billion so far this year out of 222. So equities have come back a little bit in terms of flow. But when you look at where it's going into equities, it's still playing defense, right? It's quality, it's income, and it's big, large cap like BTI, S&P 500, VOO, SPY. That's not money that's chasing growth returns. Despite the fact, as you point out, this has been an incredible year for growth equity. And it's been an incredible year for niche corners of the market. I mean, we got to point out that things like GBTC are up 50% this year because of what's been going on in Bitcoin. So there are opportunities to make outsized gains here. Most financial advisors are still playing defense, though.
Yeah, I guess that's what's amazing. I want to talk to you about Bitcoin in a minute, but I want to stay on equities right now. So I want to talk about the catch-up trade, the FOMO trade. I keep waiting for it to happen. Maybe it won't, but I'm going to stick on it, okay, because it's my show. So you and I, we've talked about this, what might work and what not work in the second half of the year. But it kind of depends on your point of view, right? So let me hit you with some things and ask you where they might go here. If you believe the market's going to broaden out to include sectors other than technology, what do you like? I know you've talked about the RSP in the past, the equal weight ETF. Why would you like that? Why would that make sense?
If you're looking for non-tech exposure and for the market to broaden out, RSP is great. It's equal weighted S&P 500. Everything's on level ground. Or VXF. I think this is an under the radar fund. It's a Vanguard extended market ETF. It's everything but the S&P 500. So a lot of mid cap exposure.
Small and mid cap.
Exactly. Another great way to judge market participation. If you're looking for the catch-up trade, I think those are your two best bets right there.
I'm going to hit you on a couple other points. And Dave, of course, weigh in anytime you feel you want to add something here. But how about inflation? Go ahead, Dave. Go ahead.
I was just going to say, if I was going to pick two, I think advisors have this right. I think playing a little bit defensive this rest of this year as opposed to trying to chase tech is probably the way to go. I like things like JP Morgan's Equity Income ETF, the largest active management fund in the world right now for ETFs. JEPI, that's been a huge flow gather. It's delivered for investors. And I got to agree, I think something like extended market or equal weight exposure is a great way to try to leg back in if you've missed that rally so far this year.
Okay, how about inflation? I get notes all the time from people who think inflation's not going away. So if you think inflation is still going to be an issue, but you want to stay in stocks. I asked you, there's a Fidelity Stocks for Inflation ETF. This tracks an index of large and mid-cap companies that are tilted towards inflation-sensitive sectors.
Yeah, if you're worried about an event happening and inflation becomes unanchored, right? I know we've been decelerating here globally, which is great. But if you just want some protection, buy the FCPI. That's a basket that all these should protect you should things start to turn up again.
Yeah.
There's other options out there. INFL, that's an inflation beneficiaries ETF. I would watch the relative performance here. They have deteriorated which should suggest that inflation maybe does not become an issue again. But just in case you're worried about that, or you have clients who are worried about that, that's the way to go.
We had 3 big IPOs last week, and the IPO market's starting to look like it's open, not quite. So this is an interesting play, because if you think the broad market rally is going to continue, IPOs should do well. The Renaissance Capital IPO ETF, this is a basket of the last 50 or 60 recent IPOs. They're up 35% this year. That's twice the S&P performance of the S&P.
I like it as a risk barometer. If this fund continues to act well, that suggests to me it's risk on still for the markets. And also keep in mind, I don't know the exact decline, but you're probably in the 70 to 80% drawdown from the peak in 2021, along with other growth plays. So this is still very much in recovery mode. Yeah. And it's a good first half, but I think there's a lot more.
Amazing thing about this, Dave, the Renaissance Capital IPO, which I tracked very carefully, is it's theoretically 50 or 60 the most recent IPOs, but the most recent ones were like 3 years ago. So there's stuff in here like Snowflake that's from 2020 here. Not that there's anything wrong with that, but it's a little long in the tooth, some of these for IPOs.
I agree, but I think that this is a really interesting window to think about getting into IPOs. Think about it. If you're a small private company and you're trying to continue operations, historically, you've had 2 sources. You've been able to go get debt, maybe from your venture capitalist, maybe from a bank, or you've gone to the market and done an IPO. In a higher interest rate market, going IPO all of a sudden looks even more attractive than it might have already. And obviously, as you point out, with 30% run in the NASDAQ already, which is a pretty decent proxy for new IPOs, it's real tough to argue this is a bad time to make an IPO out there. It's been so long. I think there's pent-up demand, not just from the index funds like this, but from just the rank-and-file institutional investor.
We keep waiting. The cynics out there, and there's a lot of them about this IPO play, keep saying, well, wait till the Reddits come, or the Fogo de Chaos, or some of the, or ARM, big semiconductor, chip manufacturer or design manufacturer. And it's true, they haven't come. The big names haven't come. But we are slowly opening up. Another one I get a lot of cynical comments about is the AI. Of course, we all know AI has sort of driven a lot of the tech gains in the first half of the year. So what if you play against this? If you think the AI thing keeps going in the second half, there's a bunch of ETFs around this. The Roundhill generative AI and tech ETF. The symbol's chat. I like that. And that's the usual names in this: NVIDIA, Microsoft, Alphabet.
So great ticker, number one. What I like about this fund compared to others is that it's actively managed. So the folks at Roundhill, they can do their research, and if a company decides, we're going to pull back on AI, or we're going to get more in depth on AI, they can manage that, as opposed to an index that may have to wait for its rules to settle in, whether it's quarterly or semi-annually. So I like the chat play. Of course, there's other products that have been around for some time, but this would be my preferred route if you want to get that AI exposure and see how real the demand is.
Is it silly to keep chasing this AI story, Dave, given the ridiculous run-ups in NVIDIA and the picks and shovel story?
I think it's not a pure play. We run into this all the time, Bob, when we have like some cool new technology, and then we look to see how we can play it, and we end up buying Google and Microsoft and Apple and NVIDIA, which we all already own probably too much of. I think AI is here to stay. I think it's going to have a long-term and significant positive effect on GDP. I think it's very difficult to pick public companies that are going to be the outsized beneficiaries of that. I actually think looking at industrials and robotics and automation is probably where you see those economic impacts hit, but it's going to be a whole lot less sexy than buying something that says chat on the front.
Yeah, it's a narrow field. We've always had this problem. We had this problem with pot stocks, by the way. There's nothing to buy, essentially. We had this problem with Bitcoin, then there was really nothing to buy. AI, at least you have a much wider field that's actually out there at this point. But he is right. I mean, it's a fairly narrow field.
To Dave's point, BOTZ, which is a robotics and AI fund, has a lot more industrials exposure than your typical AI fund that maybe it's from chat or the fund from Wisdom Street. So I like that route too that Dave mentioned. If you wanted to get away from tech, because you already have tech exposure in your portfolio, the industrials are a beneficiary too.
Yeah, and by the way, as much as we like to make fun of this, that trade worked this year, and so did the AI play. Very much worked here. So the only question is whether it continues. How about commercial real estate? Let's play against the trope here. If you think the commercial real estate sell-off, it's been pretty noticeable, particularly in REITs, is overdone. What do you like here?
DCMB, that's the double line commercial real estate fund. It's new, relatively last quarter or so. It's from the Jeff Gundlach team, right? I think if you are trying to take a contrarian play, that commercial real estate isn't going to fall apart, this is the place to go. Why would Double Line launch a fund in commercial real estate right into the heat of the moment here? I think they see an opportunity. I think if you want exposure to that corner in a slice of your portfolio, this is a way to
and
play
this
it too.
is commercial mortgage-backed securities too.
Yeah.
Remember, these are not necessarily properties here. These are commercial mortgage-backed securities.
You're getting a little more exotic than just buying a plain vanilla REIT fund that may have office REITs in it or something like that. So, which I do like.
And I think, if you're going to go with something that's contrarian, like investing in real estate right now, I think this is one of those cases you want somebody minding the store, right? So having an actively managed approach where you've got seasoned real estate folks making security selection decisions, if you're going to be a contrarian, get some help.
Yeah, I would agree with that. In this kind of situation, and I agreed with that. As you know, I'm a passive guy, but active management, I thought, did very well when the bond market was moving around like crazy. Those are the kind of situations when things are moving fast. Active management can really, I think, help. Dave, I want to switch the subject up. Bring us up to date on the Bitcoin ETF filings. We talked about this. Oh, don't laugh. I have you here because that's why you're here. We did this last week. We had the BlackRock and Fidelity's now jumping in. So handicap this one for us. Will this one get the go-ahead? And if so, why? What would take it over the top?
Well, everybody refiled, depending on how you read the paperwork. Most of them refiled on Friday. Some of them claim to have refiled a little bit earlier. All of them are now talking about having a surveillance sharing agreement with Coinbase, the largest, Bitcoin USD dealer in the world, largest Bitcoin exchange in the United States. And I think there's this idea that somehow BlackRock knew something and that the SEC is on the verge of proving this once these surveillance sharing agreements are in place. I'm still fairly negative on this. I think we've reset the clocks here. It actually puts the ARK and 21 shares out ahead if they follow the letter of the filings. But I think what's most likely to happen is we're going to get a response from the SEC that says new filings and SSAs have to look like this. Everybody please refile by X date, and then they'll make a decision. I think it's unlikely that they simply anoint a single winner and say, hey, BlackRock, you get to go out to market a week before everybody else. We all know what that looks like. In this market, being first really, really does matter, especially if first comes under the umbrella of somebody like an iShares BlackRock. So I think the odds are still negative for this year, but certainly things look more positive than they did maybe 3 weeks ago, 6 weeks ago.
I would certainly agree that they're not going to approve BlackRock suddenly and ignore everybody else. That would create a real howl. But I think the real question is, what's different here? Do you think this surveillance agreement, this Coinbase surveillance agreement, really is enough to satisfy their objections about fraud, custody issues, and all of those things? Is that by itself going to do it?
It shouldn't be, based on what they've said before, the words out of their own mouth, not just about Bitcoin, but about other markets where they've established surveillance sharing agreements. There's a level of scrutiny that's involved that I will be surprised if Coinbase can meet the mark on. However, if what's really going on is the SEC is looking for a get-out-of-jail-free card, they know they're going to lose or think they're going to lose the Grayscale lawsuit, they're looking for a way to say something positive about all this. If they're trying to manufacture a way to approve a Bitcoin ETF, this would be the way to do it. It would still be a big shift from what they've said in the past.
You have written, Dave, and implied that Grayscale might actually have a chance at winning. Why would they have a chance at winning? And I would agree, if they have made a calculation, they might lose. This might be a backdoor way to, sort of smooth things over. But why do you think Grayscale has a good chance of winning?
Well, if you actually dig through the case as an impartial observer and you look at the facts being presented to judges, 3 judges in this case, I think it's quite reasonable to say that the SEC has been arbitrary and capricious in how they've applied certain rules. Now, that doesn't mean that they necessarily approve the conversion of GBCT to an ETF, but I think they can still lose that lawsuit that says, hey, you've treated somebody unfairly under the Administrative Procedures Act. So that's a real case for them to lose. It doesn't necessarily mean they flip the switch and all of a sudden it's trading as an ETF. That's a much more complex process.
Yeah, I must say I have a problem with this argument that they approved a Bitcoin futures ETF, therefore they must approve it a spot Bitcoin. In a futures product, you have a closed ecosphere, essentially. You have positions, you have long and short that can be easily monitored, and you don't have that in the Bitcoin ETF. The spot Bitcoin situation. So there's a difference here, it seems to me. Even if you can make an underlying argument, well, if there's fraud in a spot Bitcoin, there would imply there'd be fraud. Do you get my point here? I'm not sure that it's the same argument.
It's actually sort of backwards. When they originally rejected some of the filings back in 2018, what the SEC said was, historically, when we've approved commodity spot products, there has been both a spot market and a big futures market, and the combination of those two is what gave them solace to approve those products. But then they went ahead and improved the futures product and not the commodities sort of spot product. So they've sort of talked out of both sides of their mouth on this. I think it's unlikely that they're going to win, largely because of details in the case. I agree with you. They're different markets, and it's actually, I think, reasonable to say you can trade futures, but you can't trade spot. We say that about oil, and nobody has any questions about it, right? Because there are mechanics of the oil market that don't let you do this. The mechanics of the Bitcoin market are much more like gold, and therefore it's much easier to do. Storage is trivial compared to oil, but I think it's still likely they're going to lose.
I want to ask about a survey, moving on here, and thanks for your input on that, about RIAs and advisors, because that's the heart of this whole ETF game. And Verify, you guys regularly go out and survey advisors. You're very much on top of what the advisor RIA community, and you had an interesting survey out. I want you to share this with us. What percentage of your portfolio is allocated to ETFs? It's a pretty simple question. I was surprised at the answers. It says here about half of the advisors are using ETFs for more than 25% of their portfolio. I guess you call them power users, diehards, whatever. But a quarter are still dabbling. They only have 10 to 25% of their portfolio in ETFs, and a quarter have 10% or less. Is this a little surprising you, Dave? I would have thought RIAs would be using ETFs much more heavily just because they're just so much more cost effective. They're cheaper for clients. You can still charge reasonable fees. I don't know. Or maybe am I wrong? Is this, how am I supposed to read this data?
No. I think we have to keep in mind that when an RIA is dealing with a wealthy family, right, there's a portion of the portfolio that we think of as their portfolio, their investable market portfolio, stocks, bonds, ETFs, mutual funds. But remember, they're also dealing with cash management. They're also dealing with real estate and trusts and retirement accounts. And in those cases, things like their clients' retirement accounts, trust money, those may be allocated into private funds. They may be allocated into mutual funds. As we well know, the 401k market is still massively dominated by traditional mutual funds. So I don't find it that surprising. I think it's interesting to me that there's basically nobody not using ETFs. It's just a question of how far along on that adoption curve they are. We've been asking this question at Verify now for years in our predecessor companies, and I will tell you that number of people who are in the 25% mark goes up year after year after year. So I don't think we're ever going to end up in a world where it's 100%, but I think we're rapidly approaching a world where half of most advised portfolios are in ETFs.
Yeah, that makes some sense to me. I mean, what you're saying on 401ks makes a lot of sense. I tend to talk to the RIA community that's most actively involved, the old guys who left Morgan Stanley and Merrill Lynch to set up their own shops, and those people with the clients they're taking tend to be using ETFs. So there's a sort of self-selection process that's happening with me. But your point on 401ks make a lot of sense. Dave, thank you very much. We're going to leave it there, folks. That does it for this week's ETF Edge. My thanks to Todd and Dave. And we'd asked Dave to stick around and chat about other trends in ETFs for the ETF Edge podcast. That's coming up. And remember, you can see all of our shows on our website. That's etfedge.cnbc.com. Everybody, have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.